What's good, everyone? So my boy Warren Buffett just had a damn good interview on CNBC. Anyways, it's pretty hard to watch the interview, so I thought I'd just go over the key points. I wrote some notes down. I think it's going to be pretty fun. It was a super long interview. It started at 6 in the morning and it ended at 9. I mean, there's commercials and whatnot in between, but still like a 2.5 hour interview. I don't know. It was pretty long, but it was pretty damn awesome because the Oracle of Omaha was in Omaha in the Nebraska Furniture Mart with Becky of CNBC, and they talked a lot. So let's go over some of the points they talked about. So one of the first things he mentioned was he was saying that he is gonna buy more Berkshire Hathaway stock and that he's shifting to market value. If he continues to buy the shares, the market price of Berkshire Hathaway goes up as there's less shares on the open market. Then he said, so he released an annual letter on Saturday. He said in that letter, some of Berkshire's trees are diseased and unlikely to be around in a decade. A viewer asked him which ones are the diseased ones, but Buffett, being Buffett, declined to say. So he imagined his holdings as a great forest, and he had some great big redwoods. Those were companies that were flourishing. And then he said he had some diseased trees. So he wouldn't say which ones those are. We don't know. Maybe it's Kraft Heinz. But he did say after that there's smaller companies. He just doesn't want to say which ones they are because the employees aren't going to be very happy. I understand it. Next, a viewer asked about Greg Abel, who's Berkshire Hathaway's energy chairman and CEO, and Ajit Jain, who's Berkshire Hathaway's vice chairman of insurance operations, how much money they made. And Buffett said they made $16 million each, plus bonuses totaling $18 million in 2018. Then Buffett was asked about Todd Combs and Ted Welcher, both investment managers for Berkshire that managed $13 billion each, and if they performed better than the S&P 500 while working there. He said they both are marginally behind but better than himself. So that's a pretty big accomplishment. I mean, I'd feel pretty good if I was beating Warren Buffett in investing, just saying. I know he's 88 years old, but I'd still feel like a damn G. So I mean, it's pretty good for those guys. Then he talks about brands, products, and private label brands like, say, Kirkland's Costco and Walmart's and Loblaws and all those other brands, and how they've been kind of causing some trouble for Kraft and Heinz, right? So he said that Costco's Kirkland brand was founded in 1992 and did $39 billion last year. Okay, so Heinz has been around since 1869, and then he said that Kraft Heinz did 26 billion. So not only is it Heinz, it's Kraft and Heinz, and they underperformed. They underperformed Kirkland by $13 billion. That's pretty crazy. Then obviously the questions started to flood in about Kraft Heinz, and he did say that he overpaid for Kraft, but he doesn't believe he overpaid for Heinz. Then he talks about the $15 billion markdown that Kraft Heinz did, and he says that the market marked it down more than that, rightfully so, agreeing with the huge stock price drop. So that was a pretty big one. So obviously Kraft Heinz got destroyed on Friday, dropping 27%, and he believes that that markdown was justified and that it was coming. So that's kind of a big thing to say, as you know, one of the largest shareholders of that company. He owns 26.7% of that company, 325 million shares. So for him to say that, he's basically saying that company deserved it, which is a hard pill to swallow for a lot of people. He then says, a business does not earn more because you paid more for it. That was a direct quote from him, talking about how Kraft makes $6 billion a year and takes $7 billion in assets to run, but he paid $107 billion for them. So that was a lot. Then he says millennials' habits haven't changed that much, and according to the products they're buying, sales volume is still good, but pricing power has changed, which is huge. Okay, so he's saying that millennials, my generation, possibly your generation, are still actually buying their products. It's just they're not getting the pricing power that he thought they would have had, as in, the top echelon brands get. Then he asked if he will buy the dip in Kraft Heinz or sell. Says he has no intention as the value isn't there. Also mentions it's harder to sell and elaborate by saying that it's a large sum of money to move around, and if it was a $10 million investment, he would most likely sell. He's not really talking great about Kraft Heinz. I mean, he's kind of trashing it a little bit. I mean, in a nice way though, but that pretty much sums up what he said there. Then he was asked if the market is expensive. He then said if 3% long bonds will prevail over the next 30 years, then stocks are incredibly cheap. Meaning if this is the interest rate you're going to get on your bond, then stocks are going to outperform by a lot. He said he'd rather buy the S&P bonds over 10 or 30-year periods rather than bonds. Asked why he didn't buy more stocks or Berkshire stocks in the fourth quarter when prices were low, he said he liked the prices throughout all quarters last year. He didn't buy because he wanted to make a $100 billion plus investment that unfortunately did not work. He alluded to this also in his shareholder letter, but he would not name the company. Then when asked about the business, he said it's on this planet. Buying businesses outright is more expensive than buying stocks, he said, which is true because you obviously have to pay a premium if you buy the business outright than just buying the stock. And then asked how he critiques stocks when they go down like Kraft Heinz did. Does he buy, sell, or hold? Warren says he judges the long-term value and likes to buy off bad news that doesn't affect the fundamentals. He said he did this with both Geico and American Express. He also noted he wants Apple to go down in price so he can buy more Apple. And then asked about the 10% tariffs in China. He said tariffs at 10% have affected some of the businesses a bit, but not too much. Then the deal with GE came in and he was asked about that. So when asked about the GE, he said he likes the $21.4 billion sale of biopharma to Danier. Said Berkshire is a big customer of GE and also a supplier. He's a big fan of GE and is cheering for them to succeed. He has not read the 10K but wants to read it. The interviewer, Joe, not Becky, says he could write a check for GE. Warren says that's true and laughs it off. My personal thinking when he was thinking about making an elephant-sized position, my initial thought was GE, okay? With about $100 billion where GE was trading, it's kind of close. After he would probably have to pay a premium, it would be right around $100 billion. So that was my personal thinking, and I think the guy Joe also thought that as well. Then he was asked about multiple senators' tax plans. He then says if everyone could leave their country right now and move anywhere, the US would get a lot more citizens and North Korea would lose some. I don't think he's wrong on that. I think a lot of people would opt to move to the United States, and I think quite a few people would opt to move out of North Korea for sure. And then he then goes on to say the wealthy are undertaxed. When asked about the economy, he says on his monthly reports that he gets, home construction is disappointing and retail in January wasn't very strong. However, overall things look fine and he's optimistic for 2019. When asked about the Fed chairman, Jerome Powell, he says he admires Jerome Powell a lot and thinks he's terrific and a perfect fit for the Fed chair. He reads what he says but it doesn't affect his investments at all. So that was kind of interesting. So I guess he doesn't really care about the interest rates as much as everyone does. He says we also live in a world that wasn't described in classical economics, as in this world is much different. And I kind of took it as he was saying that economics does not determine stock prices. The only thing that determines stock prices is the business itself and the money it's making and how you judge a business. And economics has nothing to do with the business, is what I believe he was saying. Then he said stock picking is hard. He believes the S&P 500 will continue to do well though, and he reiterated many times saying bet on America. It's best not to have a political view while investing. He would vote for Bloomberg if he ran for president. Thinks Howard Schultz will hurt Democrats by running third party, though, as he'll just take away votes from, say, the leader of the Democrats. When asked about 3 million shares of Apple being sold, he said that was not by him. One of either Ted or Todd, that's his investment managers, who manage $13 billion, sold half their position in Apple to buy shares in another company. He does not want to sell Apple, so that was Todd or Ted. Warren said he does not personally want to sell Apple. His average cost on Apple is $141. He hasn't bought it over $200, but would like it to go lower so he can add to his position, preferably under $141, but it didn't seem like he thinks it's going to get there. He really likes bank stocks, as 6 of his top 10 holdings, he said, are banks. Bank stocks that he seemed to be the most fond of, in my opinion, were Bank of America and JP Morgan. He talked very fondly of them and seemed to really like them, and mentioned Jamie Dimon as well. So, yeah. He sold Oracle because he doesn't understand the business well. And when asked about IBM, he said he's very happy he got out of it, as he sold it for a much higher price and is not... He didn't really want to trash the business because he's Warren Buffett, but, it sounded like he's very happy he's not in it and he doesn't think it has a bright future. When asked about 3G, that's the partner he went on with in the Kraft Heinz deal, he said he would do future deals with 3G and still has a great relationship with them. When asked about his $4 billion loss in one day on Kraft Heinz, he said it does not affect him even in the slightest, which is kind of crazy. He also did mention that he's had other days where he can gain or lose $4 billion as they manage over $170 billion portfolio, right? That happens. I mean, if you think about $4 billion on $170+ billion portfolio, that works out to what? Like, not even 3%, like 2.5% or something. That's not even a big move. My portfolio normally moves some days more than that. So, I mean, 2.5% really isn't much, I guess. But he said he can gain and lose $4 billion and has done it before. He thinks electric cars will become more popular and is for it. He also said that Charlie bought BYD. It's a Japanese electric car maker, and he said it's not his investment at all. It's totally Charlie's, and he couldn't even tell you the price of it. He says value investing is harder because information is much easier to get. The internet makes everything easier, and he said back in his day it was much harder, so obviously now competition is much more. It's actually harder for him to buy businesses now, and Becky, the interviewer, mentioned, what do you mean? You have over $100 billion in cash. Shouldn't it be easier to buy stocks? He then alluded to this by saying, no, because he can really only buy up to 10% of a company, preferably less than 10%, because he said at 10% he becomes a trustee on the bank and things get complicated. So he prefers to buy less than 10%, preferably around 9.5% max, because if they do share buybacks, like, to give himself a little room so he doesn't have to sell instantly. Makes sense. But what he was also saying was, when you think about it, if they have $100 billion, he actually said $50 billion, and they were to put $5 billion into a company, there's not that many companies that are valued over that. Okay, he said there's about maybe 100 companies. So you have to think that if you're going to invest, say, $5 billion in a $50 billion company, that's your 10%. The company has to move quite a bit to make your money back, right? So I get what he was saying on this. I guess it is true, more money, more problems, but seems like a good problem, honestly. Next, when asked about, he's still not a fan of Bitcoin. When asked about it, he says it's a delusion and says blockchain does not depend on Bitcoin. Even JPM is making their own coin, which, I mean, I agree with him on that. I believe Bitcoin has no real value, and it's hard to value Bitcoin. Just because it's limited doesn't mean it makes it expensive. I don't see Bitcoin going to 100,000. I have another video on Bitcoin where I kind of trashed it, so if you want to watch that, check it out. Next, he says he doesn't understand the weed market and has never smoked weed. That was kind of interesting. He says he couldn't figure that or smoking out. So go figure. Warren Buffett, the greatest investor of all time, doesn't know how to take a puff out of a joint or a cigarette. Kind of interesting. But I don't know, I thought it was funny. Anyways, he's also not a fan of IPOs. That's initial public offerings, when a stock becomes public for the first time. He prefers to choose when to buy the stock rather than they sell to you. That was interesting. I never thought about that way, but that was kind of cool. Also, he believes a lot of them are overvalued. He didn't want to say which ones are overvalued when kind of talking about the new IPOs coming out. You know, Uber, Lyft, Airbnb. He just kind of says, you know, you got to value a business. This is the last one. Someone said Warren Buffett and Charlie Munger were his investment idols and still are. But he said, who does Warren Buffett think his grandchildren should admire? Warren Buffett jokingly, obviously, kind of said, well, hopefully still me and Charlie. I mean, he's not wrong. They're kind of the greatest, but whatever. But he says that fundamentals on investing will not change in the next 100 years. That's a pretty bold statement. I don't think he's necessarily wrong. 100 years is a long time, but it probably will be pretty much the same, right? It's investing. I don't think it'll change that much. I guess we'll see. If maybe I'll be around to see it. We won't know. I might have to break a record, but let's go. Anyways, he says, then he said, you must know how to value a business, and you don't buy a business unless you can value it. Then stay inside your circle of competence. That was pretty much the notes from that. That was a long interview. It was a great interview, though. I thoroughly enjoyed it. Warren Buffett is the GOAT, and he's always super interesting to listen to. I gotta say, the only note I'm gonna add to this is, for an 88-year-old man, this guy is still super sharp. I mean, obviously he pulls out a few like uhs and whatnot, but he's still a genius. The guy is absolutely phenomenally amazing. Him and Charlie Munger are just fantastic. I love those guys, man. Yeah, wow. They're great. I don't really know what else to say. If you can watch it, go watch it if you can find it. That'd be great. It's a super great interview. If you did enjoy this video, remember to give me a thumbs up. Maybe hit that subscribe button. Hit the bell notification. Always be notified when I post the latest, greatest, and most informative video yet for you guys. Yeah, if you got any questions about it, ask me down in that comment section. You want me to do a video on a certain topic, throw it down in the comment section. You want to throw me some hate, do it down in the comment section too. You know, you want to throw me some love, preferably, do that down in the comment section too. Until next time, guys, see you later and have an absolutely fantastic, amazing, beautiful, wonderful, spectacular, one-of-a-kind, life-changing day. See you later.